In the program, I'd like to welcome again.
In the program, I'd like to welcome a specialist in currency management. That's Thomas Suter. He is CEO of Quaesta Capital. He's going to talk about currencies from risk to opportunities. Thank you. I'll hand over to you. Thank you.
So good evening, everybody. Welcome to the presentation, Currencies from Risk to Opportunity. As already stated, my name is Thomas Suter. I'm the CEO of Quaesta Capital. I will give you in the next 20-25 minutes a brief overview about currency risk management, FX-based execution, and currency investments. All topics that we actually deal with for our institutional clients on a daily basis. Let me briefly give you an overview of Quaesta Capital. Quaesta Capital as such was founded in 2005, so about 10 years back. We're based here in the neighborhood. We've started initially with currency management offerings, and since then we've very much been focusing on that topic. Since 2007 we've been regulated by the FINMA, and actually since April 2014, due to a large mandate by one of the largest US pension plans, we've also had to become SEC registered. Client base of Quaesta Capital are pension funds, family offices, investment funds, corporate, and some high net worth individual clients. We've got a sister company based in Germany. They're regulated by the BaFin, and their focus is on fixed income, absolute return, and macro type investments. So what do I want to talk about? Let me then just give a few words about the world of currencies before we go into the topic currency risk management, followed by best execution and currency investments. The FX market. It's a very large, it's a very liquid market. It's actually by far the largest financial market there is. The Bank of International Settlements makes on a 3-year basis a study and a research, and one of the results they come up with are the volumes that they are traded on a daily basis. We talk about $5,400 billion traded on a daily basis. By comparison, if we add the volumes traded on the world equity markets, we come up to a figure of about $240 billion. So just on the FX side, we talk about a multiple of about 20 to 25 on a daily basis. I think the market is also a volatile one. If I had asked you where US dollar Swiss franc stood 40 years back, I'm not sure if everybody had known that at that time it cost you more than 4 Swiss francs to buy $1. Today we are below parity, and as you may remember, summer 2011, we were for a short period just at 70 cents. What does that mean? That means obviously volatility, risk to any people, investors that are related to dollars. And obviously also the same we would see with other currencies. I think I can state that currencies play a very, very important role in asset management, not least due to the internationalization of investments that we've seen throughout the last few decades. The constant search for optimization and the risk-return profile for an investment portfolio. Recently also regulatory requirements, best execution, transparency on your best execution or actually on your FX execution costs. And last but not least, the constant search for alternatives on the investment side. As such, I think currencies also playing an interesting role. When we talk about currency management, it can be always seen from two different sides. On one hand, here on the y-axis, it's the FX risk. And then we talk on the x-axis, we talk about the FX alpha. If we start on the top left, passive currency risk management, here the focus is really just on the risk. Here, there's no interest on an additional alpha generation. So what can we say there? These are two sample portfolios, a bond portfolio and an equity portfolio. With the dark green part, you see the volatility that you, as a Swiss franc investor, as a Swiss franc dominated investor, that you take via investing in those portfolios just with the asset risk in the local currency. Additionally, if you don't do any FX hedging, you obviously got some additional risk, the currency risk. As you can see from this graph, is the fact that obviously for a bond portfolio, the currency risk part is much, much more pronounced, much, much more important than the risk that you have when investing into an equity portfolio. I think that's making much sense. A typical bond portfolio is obviously much, much less volatile than a typical equity portfolio. As such, that part is much, much more pronounced. What you can see here actually on the equity investment side, we see, for instance, at the moment it would look like the equity investment in the Japanese market does not add any additional volatility from the currencies. That may be true for that period. That calculation was made with the period between 2000 and 2014. That obviously changes as you change the underlying assets and as you change the period that you want to do the calculation with. For every client that we obviously are in a discussion to provide him with a currency risk management, this topic is obviously done on the individual basis. Now on the next slide, you see actually the impact that it has from a risk-return profile on your portfolio if you assume with the light green part you got your investments converted into Swiss francs and not having a proper FX hedge in place. The dark green one is then the risk-return profile that you see for an investment, still the same investment, but now including a proper FX hedge. I think what we can state in both cases is that we tend to have similar return patterns. In some cases, the return actually has even risen, but what we see in both cases, that we see a substantial improvement on the volatility side. As such, the volatility, the risk has been reduced with a pretty similar return. And I think that's obviously what we always aim for. For a given return, I want to reduce my volatility, or for a given volatility, I want to increase the return. I think these two slides obviously show that the proper FX risk management is very much making sense. So now, what do we at Quaesta Capital mean when we talk about proper FX risk management? We look at it actually from three dimensions. A, strategy, B, implementation, and the last part is then the execution setup, where the biggest impact comes obviously on the transaction costs. All these topics are jointly with the client developed. We find agreements and then they are implemented. On the strategy part, it's obviously about defining what shall be hedged, which currency shall be hedged. Shall they be hedged with 100%? Or maybe for some reasons there's a decision to say, okay, certain currencies are not hedged. Then it is about what is hedged. Is it at asset level or is it at portfolio level? Once all these parts are decided, then it comes about the implementation. There we really go in detail. What is the frequency of hedging? Shall there be rebalancings? Shall there be certain upper and lower boundaries at which rebalancing shall take place? Then it is very much about the communication between the client, the global custodian, and us. How shall we make sure that the communication works? And what reporting is required by the client and potentially also by the global custodian? Once this is also clear, it is really about the execution. We talk here about transaction costs. This is actually an area where we think a proper FX risk management needs lots of improvement still today with many institutional investors. As you can see here, the return impact comes mainly from the strategy, but the cost impact comes mainly from the FX execution, from the transaction part. Because here, you can easily, via some additional improved setups, improve your cost base, and as such also avoid unnecessary trading costs. And the optimization of all these three dimensions leads to a proper and professional, and I think an efficient FX risk management. Now, I've mentioned the topic best execution that we think is a crucial one. It's actually become more, I think, much more crucial recently, that there is a trend, a requirement for transparency, that also, for instance, pension funds, they have to know what is their cost base, what are their total expense ratios, and all these topics. And obviously, unnecessary costs in the FX space, we talk often about hidden costs, also play their role. At Quaesta Capital, we are actually very, very active in helping our clients moving from a passive manager, from a passive investor, to an independent manager. What does that mean? Typically, or at least historically, it's been a common case that the investor has not been having direct access to the market. He was being guided, advised by the salespeople in the bank or by the external asset manager. He did not have transparency what his actual costs were. He had an indirect access, and the whole thing was not really efficient. Now, in our approach to providing, to helping, to supporting our clients to become independent managers, we give them a way that eventually they can actually do all those things on their own. They have a direct access to the market. Direct access to the market means no hidden costs, no intransparency. They really know what they pay for, and they can then decide whether that is okay for them or not. Often, they are still advised or helped by independent advisors. For instance, on the FX side, often an institutional investor takes the advice, the support by a so-called currency overlay manager, who's a specialist in that field, but typically, via a very transparent model, is being remunerated. Now, I mentioned before that the FX market is large and liquid. That's true. But very often, even though it is a very large and liquid market, the market is non-transparent. Why is that the case? Still today, about, I would estimate, 90 to 95% of the daily traded volumes in the FX markets are over the counter. So that means, unlike equity and bond trades that are typically traded via the exchange, they are traded on the OTC market, in the interbank market, and you as a client often do not really have a clue whether you were treated fair or not. We also talk about a topic of principal-agent issue. When you're treated, when you're advised by your bank sales, he's working for you on an agency basis. Also, I think the external asset manager is probably working on an agency basis. But at the same time, when the salesman of the bank goes to his trader, we know, and that's natural, the trader has one idea, he has one goal. At the end of the year, he wants to generate as much profit as he can. So as long as the client is not really aware of that fact, and as long as the client is not cost cautious, there is the risk that you as a client pay more or get less than what you should do in a good approach. Now, as said, there's different challenges you have there: transaction costs, no information efficiency, no competition, and then obviously it's a difficulty to monitoring these FX rates. Now the question is obviously, how can that be improved? And that's actually not so difficult. Of course, if you're a private individual, you may trade you a few $100,000 or even $2-3 million per year. It's probably not making sense to consider a professional trading setup. But if you're a pension fund, if you're a family office, if you're an investment fund, and over the course of the year you may trade a few $100 million or even billions of volumes, then I think it's worth the effort to set up an improved and efficient multi-bank trading setup. Why that multi-bank setup, actually why the increasing of the number of counterparties, you automatically move away from a passive manager to a more independent manager, and automatically you get more awareness, you get more transparency, and you actually start to creating a competitive market environment between the providers. And I think nobody has to think that we talk then about, let's say, poor banks. I mean, we don't want to make any bank bashing at all. But as a matter of fact, all the large hedge funds, all the large pension funds, they are running such multi-bank trading setups for a long time. And they are still very good clients for banks because they trade huge volumes. And these huge volumes do not justify huge spreads, huge margins, because the money is still made with lower margins but larger volumes. I think once you have this setup, possibility to trade with different banks, you're in a very good position that you are really having a cost-efficient, transparent and optimized setup. Now, how we do that? I mean, typically our clients are using, if they are large enough, they're using a so-called prime brokerage setup. What does that mean? A prime brokerage setup means that you as a client have got one central counterparty. Let's say, for instance, UBS is your main bank relationship, and let's assume you are a large client who trades multi-billions of FX per year. They will set you up a prime brokerage. In that prime brokerage, you then have the possibility to trade with multiple banks. Typically, they would set you up with 5 banks that you can decide. You can ask, you can have a discussion with them, and then you can ask at the same time, when you have to trade with 5 or 6 banks, you get a quote, you trade automatically with the one that makes the best price. That risk between that bank and UBS as your prime broker is taken over by the prime broker. For you, that makes the whole case very efficient. You don't have different banks. You don't have different collateral management, margin management, cash management needs. That is all done with the prime broker. I think that's a very smart and very good setup that large pension plans, large family offices and large funds have in place since a long time. Now the problem comes when you are a client, let's say, that is large, but not that large. Let's say a client that may have $500 million, $1 billion, or even $2 billion of FX trading volumes per year. Typically, such a client is not large enough to get a prime brokerage. Or, if he gets it, he may be charged a huge service level fee which just offsets him. Now at Quaesta Capital, since we are in contact, since we are in dialogue with many so-called medium-sized companies that may have a currency exposure of a few $100 million equivalent and may have trading volumes that may just be in the region of 1 to 2 billion, we have been searching for a way to offer them also a prime brokerage setup, but also with the possibility to do that when they're not large enough. And now I take the liberty to make just a little bit of marketing. I mean, we've actually been successful to start a cooperation with Zurich Cantonalbank, which in particular in Switzerland is obviously seen as a good player, very well known, one of the few remaining AAA banks. And with Zurich Cantonalbank, we have now access for these types of investors to benefit from a prime brokerage setup. Actually, to benefit from this prime brokerage setup at a very low service level fee, which is almost not of any relevance, and the client then can really benefit from a cost-efficient, optimal, transparent prime brokerage and FX execution setup. Here you can just see such a trade plotter. When we talk about transparent pricing, I think what is required is that you know, this is on the top, that you know when a trade was done. Still today, many clients, they don't even know when the trade was done. The markets fluctuate during the day, and they may not even get a confirmation at which time during the day the trade was done. In the middle here, you can see what was traded, what were actually the trade details, and in the bottom, you see which banks. In this case, this client has got 5 banks that he can trade with. These banks have been automatically asked for a quote, and we automatically trade with the one that makes the best price. I mean, the pricing that we see here, this is not of relevance. The next quote that is asked, we may just have the complete other way around. The bank who has done the worst price may be the one who has made the best price. But the client has got guarantee that he's got transparency, he's got best execution, and that's the way I think it should work. Now just a few words on the currency risk management, currency investment side. I think currencies have a few characteristics that should be very interesting for investors. They provide diversification, they are very liquid, as we have seen, and actually also been proven in the midst of the financial crisis in 2008. There was not one investor who had a problem when he wanted to redeem from a currency investment. So that is all fine. Now the question is really, where are we today? I mean, we have been in a market environment of central bank dominated markets. As a result of that, we have seen very, very low volatilities in the FX space. It's been a very, very challenging market environment for FX managers. As you can also see from the Quaesta Volatility Index, which is nothing else than a trade-weighted volatility index, that has tended to go lower every other year. I think we skipped that one. Now the question is really that you have to ask yourself, okay, how do I see the future? Will we come into an area of more trends, of more volatility? And I personally think there's many, many good reasons to be optimistic. We see currently a divergence at different levels. The central banks, starting from the Bank of Japan, with the ECB and the US Fed, they're at different levels. Some have just started with QE, others have started finishing it. So the result of that is that on the interest rate side, on the QE activity, we will see diversions which should fundamentally, on the long run, lead to more volatility. As such, I think a good environment going forward for FX managers. I think to finalize that, when you want to make an investment in currency, I think it's very crucial to know what you really get. Currency programs, they may differ a lot. There's those types of programs that are more growth-oriented. They typically do well in the risk-on environment. What you can actually see here are the correlation figures. And then there's those who do well in a risk-off environment. And then there's so-called market-neutral type strategies. One sample of such a market-neutral type strategy is our own volatility strategy. The focus there is on non-directional volatility trading. And as you can see also from the correlation on at the bottom, the program is sometimes positively correlated, in other times also negatively correlated. And I think from that point of view, an interesting alternative. But as said, it's very important for you as a client to know what you want from that. So now just to finalize, because I've seen that we're running out of time, do currencies matter? I think very much yes. I mean, the internationalization, the continuation of the optimization of the risk-return profiles, the regulatory requirements in regards to best execution, I think it is very crucial for a professional investment manager to look at these things thoroughly. And last but not least, I would think we are in an environment where for the next 2, 3, 4 years, we may see attractive opportunities also for currency as an alternative investment opportunity. Having said that, I thank you very much for your attendance. If you have any further questions, we are at your availability later on. Thank you very much.